Hello, my fellow investors, and welcome back to another fundamental analysis video as well as earnings report video 2. Guys, we're going to take a look at the company Cisco. We actually just covered this a few hours ago on the live stream for the Rumble exclusive live streams that we're doing for the next 30 days. So because I don't want to just neglect YouTube, obviously, you guys are like 3,000 of you guys. I don't want to neglect you guys. I'm going to be putting out a video of one of the stocks that we covered on the live stream. So obviously, if you guys see the live stream, if you guys follow us on Rumble, you guys can see the stocks. However, I'm going to put out one of those stocks as a solo video for you guys to see. And we covered Cisco as one of these stocks, and that's the one I really want to cover because this is actually a really interesting stock right now. In fact, we even compared this to what it was back in the 2000, the dot-com bubble, and believe it or not, it's actually a pretty good buy right now. So we're going to cover this one, go through the earnings, and then we're going to see if at the current share price it's looking like a buy. So with that said, guys, make sure to like, subscribe, comment. Really does help here on YouTube as well as Rumble. And of course, follow us on X. And again, we are live streaming every day, 2 hours a day, minimum 5 days a week for the next 30 days on Rumble because we actually got partnered. So the link to the Rumble channel is linked in the description below too. So with that said, let's get started with this analysis. So let's take a look at their earnings, guys, and they actually have a weird earnings season where they're actually in Q2 of 2024. Yeah, it's a little bit strange, but it is what it is. So we got over here the news summary. $12.8 billion in revenue, down 6% year over year. GAAP EPS of 65 cents, down 3% year over year. And non-GAAP EPS of 87 cents, down 1% year over year. Revenue growth in security, collaboration, and observability. Progress on business model transformation in Q2 fiscal 2024. Total software revenue was flat year over year and software subscription revenue up 5% year over year. Total annualized recurring revenue ARR at $24.7 billion, up 6% year over year, and product ARR up 9% year over year. Remaining performance obligations RPO at $35.7 billion, up 12% year over year, and product RPO of up 12% year over year. Dividend, they actually raised their dividend by 3% to now 40 cents per share. And when it comes to the Q3 for the fiscal year 2024 guidance, because remember they're still in their 2024 year, they haven't ended it yet. We got over here revenue of $12.1 billion to $12.3 billion and an earnings per share of 51 cents to 56 cents on a GAAP basis, and then on a non-GAAP basis 84 cents to 86 cents. And for the remaining 2024 fiscal year guidance, we got revenue of $51.5 billion to $52.5 billion and then earnings of $2.61 to $2.73 on a GAAP basis, and then on a non-GAAP basis $3.68 to $3.74. This, however, made the stock drop after market as soon as they released earnings 5.27%. In fact, they actually did rebound a little bit, but they're still down massively. And this was mainly due to the fact that when it came to their guidance for 2024, Q3 and the whole entire year, they're missing when it comes to the consensus. You guys can see over here, we already took a look at this of revenue of $12.1 billion to $12.3 billion for the Q3 2024 fiscal. The consensus is $13.1 billion. They're not even getting close to that, right? On the lower end, they are down $1 billion. And then on the earnings per share, you guys can see that right here, that the consensus was 92 cents. And again, doesn't even get close to that at all on a non-GAAP basis of 84 to 86 cents. On a fiscal year 2024 guidance, revenue of $51.5 billion to $52.5 billion, they were expecting, the consensus was anyways, $54.47 billion. And then the earnings per share, once again, on a non-GAAP basis, $3.68 to $3.74. They were expecting $3.87. That's essentially why the stock fell 5.27%. And if we take a look at this thing on the 1 year perspective, they are up 5.41%. Year to date, they're down 0.5%. But the important thing to know here is that we are actually nearing the 52-week low, $45.46, and a peak of $58.19. What's important to know about this whole entire company, though, is that if we take a look at the max, we can see that, guys, this was such a massive stock back in the dot-com bubble, reaching a price of around $79.38. And well, after that, they crashed. And ever since then, they have never, ever gotten to that price. So please remember that number because we're actually going to see that number, or at least something close to that number when we get to the calculator. And it's going to prove that it wasn't worth $79.38 in 2000, but it may actually be worth that now. So with that, let's now move into The calculator, we got the ticker for CSCO, market cap of $204.3 billion, a PE of 15.17, share price of $50.28, annual dividends per share of $1.56. If we take a look at this dividend, this is a yield of 3.14%, a payout ratio of 37.53, a 5-year CAGR of 3.4, dividend growth of 12 consecutive years. Ex-dividend date passed as of January 3rd, payout date was January 24th, and they do pay their dividends quarterly. Coming back over here, based off of their current shares outstanding and this $1.56 in annual dividends, they pay out $6.32 billion every single year. Surprisingly though, subtract this from the 5-year average free cash flow, they're left with $8.91 billion. That's really good. And in regards to their last year's free cash flow, that's even better, $12.72 billion. These payout ratios are insane, 33.2 and 41.5. I look at this and I'm like, you know what? This is actually not looking too bad. They can't afford this dividend. If they wish to even increase it, they could still afford it. I like anything under 60. I look at this and I'm like, good. However, they need to keep going because, man, after .com, they have never recovered when it comes to the share price. They're having current problems right now when it comes to their revenue guidance and earnings guidance for 2024 or their fiscal 2024. So this could get rough, but right now as it stands, it's not looking too bad. So let's take a look at now the fundamentals, starting with the net income. We got 5 years ago of 11.6 billion to 1 year ago of 12.6 billion, increase of 9%. They were decreasing 5, 4, and 3 years ago, but ever since then, from 3 years ago, 2, and 1, they were actually increasing it at a pretty good rate. We gave this thing, guys, a 70% for me and a 75% for Mike. The free cash flow looks also very similar. 5 years ago of 15 billion to 1 year ago of $19 billion, increase of 28% with an average of 15.23 billion dollars. Actually looks a lot better than that of the net income. You can see that they did dip from 5 to 4, but then from 4 to 3, they actually slightly increased it, dipped in 2022, you guys could see right there, and then as of 2023, you guys could see that they essentially recovered. I'm going to give this guys an 80%, and Mike gave this thing a 75%. When taking a look at the revenue, 5 years ago of 52 billion to 1 year ago of 57 billion, increase of 9.81%. Once again, it looks very, very similar to that of the net income and the free cash flow. You can see that they dipped 5 to 4, probably because of COVID. And then from 4, 3, 2, and 1, consistently increasing. I gave this thing an 85. Mike gave this thing an 80%. The assets minus liabilities is by far the best one, all except for 1 year. This is consistently increasing. We got the average total assets of 97.4 billion, liabilities of 55.7 billion, and this is a difference of $41.71 billion in the positive. I gave this thing a 95, and so did Mike. Now the cash flow minus liabilities is looking very interesting because this is actually heading towards to zero. From 4, 3, and 2 years ago, stagnant. However, if we take a look at the cash flow for the same years, pretty much stagnant too, right? All except for the 2 years ago, right? But all in all, it's still looking like the cash flow is able to sustain the liabilities. You guys can see right here. As of 1 year ago, they were at negative 38.5 billion. The average being negative 42.6 billion. I gave this an 80%. Mike gave this a 70%. And the shares outstanding looks absolutely incredible. Consistent buyback all throughout the past 5 years. You guys could see going from 4.25 billion to today of $4.05 billion. That's a decrease of 4.73%. And from the previous year to the current year, a buyback of 0.42. We both gave this thing 100%. And lastly, cash and equivalents they currently hold, 9.6 billion with an average of almost $10 billion. When taking a look at the overall grade, I gave this thing an 84% and Mike gave it an 81%. Yeah, guys, believe it or not, Cisco right now is looking like a decent company to buy. Very, very interesting, isn't it? Because, well, back then, maybe the fundamentals weren't that good, yet it still gained a massive amount. So let's take a look at the discounted free cash flow because this one's going to come as a shocker. Looking at now the discounted free cash flow, this thing right here, guys, shows pretty much everything. Now we already input the numbers. Mike put in the share buyback of 4, 5, and 6% and the revenue of 2, 4, and 6%. We essentially got that revenue from Seeking Alpha, where their forward is estimated at 2.84 and the sector median is 6.81. So that's essentially where Mike got those numbers. And with this, we get the target share prices of 57.66 to 67.64, not adjusting for debt, and then adjusting for debt 117.79 to $137.79. The reason why this is important is because, well, because you guys do remember that all-time highs in the .com, right? it was around $79. So there you guys have it. That's the reason why I constantly say every investment is the present value of all future cash flow. Back then, the stock wasn't worth that much. However, today their fundamentals have changed, and now by the looks of it, it is worth it based off of these assumptions. Does that mean that it's going to happen? No, but it's a better prospect now than what it was back then. Because if you bought back then at that price, because if we take a look back at this graph, we can see that if you bought this thing at this point, you have not made your money back at all, right? At all. It's been 22 years and you have not made your money back. However, back then, I don't know what the fundamentals were, but most likely they were not worth that because then the price fell and they never recovered. Now the fundamentals are actually pointing to the fact that this might be a decent buy at the price that, it was 22 years ago. So every investment is the present value of all future cash flow, guys. And this is what I'm trying to say every time, that you do not want to overpay for companies. Does that mean that the price of this thing will go to that level? No, but I'm saying now, by the looks of their fundamentals and based off of these assumptions, in the future, the stock price of around $57 to $60, let's just say $70 does make a lot more sense than what it did before. Not adjusting for debt, and then if you adjust for debt, it actually shoots up a lot higher. So again, not financial advice. Every investment is the present value of all future cash flow, as I just said repeatedly. Guys, look at this company for yourselves. Take a look if maybe you find something in their earnings report. The link to their earnings report will be in the description below. Please read it for yourselves and take a look at their 10Ks. Take a look at everything else because it's not financial advice. Every investment is the present value of all future cash flow. And if we take a look at this dividend, if we put in $5,725, this nets you $177.63 in dividends. Now, I would normally say be careful with this, but honestly, looking at the overall payout ratio when it comes to this dividend, again, that was actually really good, 33.2 and 41.5. Not saying that they won't be able to cut it, because if things go wrong, they will. But based off of this, it's looking pretty all right? It's looking very, very good. So yeah, that's just my 2 cents, guys, when it comes to this dividend. It looks good, but please be very, very careful. Their cash flow is not like a Microsoft cash flow where you're just like, yeah, this is clearly they're able to afford it, no issue. They can, but they could come across some problems like Intel did. All in all, that pretty much does it when it comes to Cisco. It's a company that back then wasn't worth it. Now it might actually be. But again, please do your own due diligence, not financial advice. That pretty much does it, guys, for this one. Make sure to like, subscribe, comment. Really does help with the algorithm on YouTube as well as Rumble. We are live streaming on Rumble for the next 30 days, 2 hours a day, 5 days a week. We're live streaming Wednesday, Thursday, Friday, Monday and Tuesday, and then repeating again. The week essentially starts on Wednesday, and then repeating again up until the 30 days are up. So if you guys would like to see that, you can stop by there. With the link to the channel is in the description below. You don't have to sign up to Rumble if you don't want to. You could just watch us. We just can't really comment. If you guys just want to watch us, then you guys could watch us there. 7 p.m. Eastern Standard every single day, or at least Wednesday through Friday, and then Monday and Tuesday. So thank you guys so much for watching. Peace out, and we'll see you all next time.